You ever see gold or silver have one of those big days and think, man, I wish I could have supercharged that gain? Well, there are actually financial tools out there that promise to do exactly that, to deliver double the daily returns of precious metals. But is it really that simple? Let's dig in and see how these things actually work and uncover the critical details that can make or break a trade.
Okay, but before we dive in, we have to get the important stuff out of the way first. Just so we're all clear, this is for educational purposes only. It is absolutely not trading or investment advice. Our only goal here is to break down how these complex products tick so you can be better informed. All right, let's get to it.
So let's just start with that really tempting idea. What if, on a day, gold jumped up 1%, your account went up 2%? Or if silver popped 3%, you'd see a 6% gain. I mean, that's the core promise of these leveraged ETFs, and you can see why it's such a powerful hook for traders who are looking to squeeze every last drop out of a short-term move.
All right, so let's get into the guts of this thing and meet the specific tools we're going to be dissecting. For silver, we're talking about an ETF with the ticker AGQ. And for gold, it's UGL. These are the big players designed to give you that 2 times leverage every single day. Now, when you put these two side by side, it's kind of striking how they're basically twins. Both are shooting for that 2x daily return. Both have the exact same 0.95% expense ratio. But here's the key detail you've got to catch. Neither one of them actually holds physical metal. They're built as what's called a commodity pool, and they use other financial instruments to get the job done. And let's be really clear about that, because it's a huge misconception. When you buy a share of AGQ or UGL, you are not buying a little piece of silver or gold that's sitting in some vault. No way. Instead, the fund is using derivatives, things like futures contracts and swap agreements, to basically mimic the price moves and then amplify them.
Okay, this right here brings us to the most critical and honestly the most misunderstood part of how these things work. It's called the daily reset, and it's the entire reason why 2x daily is completely different from 2x over a month or a year. So here's the deal. That 2x target, it's only good for one single day. At the end of every trading session, the fund has to rebalance its entire portfolio, buy or sell its holdings, just to make sure it's set up to hit that 2x target for the next day. Think of it like hitting a reset button every single night. And this constant resetting has some really weird and often surprising long-term effects.
And you know what? They're really, really good at it. The data here for the silver ETF is just proof. All those dots form a nearly perfect straight line. It means that on any given day, AGQ does exactly what it says on the tin. It delivers twice the return of silver for that day.
And it's the exact same story for the gold ETF, UGL. I mean, the daily tracking is incredible. They hit their target with laser-like precision. But here's the twist. This daily perfection is exactly what creates the long-term problem. This quote really hits the nail on the head. Because of that daily reset, the compounding math gets all twisted up and starts to work against you, especially in a chalky market. So if the price of gold, say, bounces up one day and down the next, but ends up right where it started, this leveraged ETF will actually lose money. Let's walk through the math so this really sinks in. Imagine you start with $100. Day 1, silver jumps 10%. Awesome. Your 2x ETF goes up 20%, so now you've got $120. But the next day, silver falls back about 9.1%, which puts it right back where it started. Your ETF has to fall twice that, or 18.2%. The problem is, 18.2% of $120 is a loss of almost $22. You're left with about $98. The metal is flat, but you've lost money. So that sneaky, destructive little math problem we just saw, yeah, it has a name: volatility decay. It's this gremlin in the system that eats away at your investment over time, especially when the market is just bouncing around. The more the price zigzags, the more this decay is going to chew up your money. And as if that wasn't enough to worry about, on top of the whole volatility decay trap, there are a couple of other, let's call them hidden hurdles you've got to know about. We're talking fees and some pretty annoying tax paperwork. Oh yeah, this is a big one that catches so many people by surprise. Because these ETFs are technically commodity pools, they don't send you that simple little 1099 tax form you're probably used to. Nope. Instead, you get something called a Schedule K-1. And trust me, it can make tax time a whole lot more complicated, and it often shows up late.
And then there are the other little costs that just keep chipping away at your performance. You've got that 0.95% annual fee. You've got costs from rolling the futures contracts, which can create a drag if future prices are higher, a thing called contango. And of course, you've got your own brokerage commissions every time you buy or sell. It all adds.
So, look, when you put all of this together, the volatility decay, the fees, the tax headaches, a really clear picture starts to form about what these products are and what they're not. They're not a treasure chest you just buy and forget about.
Here's the bottom line. These are absolutely not long-term investments. They're not a buy and hold way to own gold or silver. They are purpose-built, tactical tools for traders making very specific, very short-term bets. We're talking days, maybe a few weeks at the absolute most.
Now, you might be thinking, well, what about just buying gold and silver miner stocks? And that's a fair question. With miners, you get longer-term exposure, you don't have that daily decay problem, and you get a simple 1099 form for your taxes. The trade-off? Well, you're buying a stock, so you've got stock market risk and risk specific to that company. They're just two very different tools for very different jobs.
And that brings us right back to the final question you have to ask yourself. These tools, they offer some serious, powerful leverage, but they come with equally powerful risks, like those daily resets and that nasty volatility decay. So the question isn't whether these ETFs are good or bad. It's whether you understand the risks and are truly equipped to use them for a very specific, short-term tactical trade. Knowing exactly how the machine works is always the first and most important step.